I have so much respect for founders who are able to bootstrap their companies up to a certain point where they really do have true proof of concept. And with real estate, it's the same way. There's nothing worse if you're looking for one of the bigger red flags in real estate deals where you see like a 3% acquisition fee and a 3% sponsor co-invest. There's no way in no universe that that's a good deal, irrespective of what asset class it is.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. Kristina, thank you so much for joining me for an episode of Money Moves. I appreciate you coming on the show.
Of course. Thanks so much for having me. This is a perfect way to start the week.
Yeah. So I would love to start by just asking about your career from a survey view. Like, what has been your transaction volume or like total amount of real estate you've purchased or deals you've done in your career so far?
So I started out kind of in the institutional world before moving on to run my family's business. And I would say probably in aggregate about $1 billion of transaction volume across various different asset classes.
Yeah. And when you think about that, is there a moment you can go back to in time where you said, I want to work in real estate, I want to invest? Was it like when you were a kid or somewhere along the way that you had that moment?
I think it was probably my first summer working my family's business, and I was 7, and I'd go visit properties with my grandfather. And from the start, I absolutely loved it. And I wasn't sure whether I loved it because they introduced it to me at a young age or because I really loved it. So I tried a bunch of different things in my 20s and always came back to real estate. So I'd say probably pretty early age.
Yeah. And when you got into it professionally, you know, after college, first time it was maybe a true vision of your career, did you ever think you'd be where you are now?
I mean, I hoped I would. My vision when I was 22 and starting my career, I worked at a shopping center REIT out of college, was that I would eventually move to my family's business and build kind of a private equity platform within that. So we're in the process of doing that right now.
And it sounds like you've had to figure out a lot of things along the way, even though you're coming from a pretty established firm in Equity One and coming into the family where there is a bit of history and experience. You're thinking about how to expand things and take them to the next level. Can you talk a little bit about what your experience was before and then what it is that you saw you wanted to do that was new, that wanted to be an expansion?
I mean, I think the family business literature is pretty unanimous in that for family businesses to survive from generation to generation, every generation has to come in and reinvent what that business is. And so when I was looking at what my family business was, spending summers there when I was a kid, and then having that institutional real estate experience, I knew for us to make it in the next generation, we'd have to institutionalize everything that we're doing with our own portfolio and then bring that institutional platform onto our family business as well. It is kind of just the evolution of seeing that through the course of my career at different shopping center REITs. And I spent a summer at Lehman Brothers. It was the last class of summer analysts at Lehman Brothers. I don't know if that's a good or bad thing, but it did give me exposure to see what that finance world looks like. And then being able to put that in place within my family has been sort of the goal from the beginning.
One of the things that we've talked about before is the different asset classes and sub-asset classes within real estate. And you've mentioned an interest in different ones and how they have evolved over time. Can you give me an understanding, I guess, of the breadth of sub-asset classes that you focused on and what makes some more interesting than others or how they're different?
I mean, I think I love most of them in their various different forms. And I think that over time, over the course of a career, you're going to see alpha in different sub-asset classes at different times. And it's really kind of up to the people who are market specialists and asset class agnostic to pick and choose and find that alpha at a given point in time. And so I started out in shopping centers in 2008 to 2011. And that was during a time when you saw like Circuit City bankruptcies, Linens and things. Now I'm aging myself, and Borders books. And there was kind of a bit of uncertainty around where retail was heading. And that kind of was sort of where I started, and seeing that evolution and seeing asset classes change over time, I think really shaped my perspective. Now looking into finding niche theses where we can invest and execute on a sub-institutional level. And so my family, on our balance sheet, we have all the main food groups: office, retail, multifamily, hotel, industrial. And as we find new things, we kind of look to see where institutions are just starting to come in, knowing that in 3 to 5 years, we will be able to kind of aggregate a portfolio and sell to institutions, and there'll be a ton of institutional appetite. So we started out in self-storage. We purchased 8 self-storage assets. 7 were existing, and then 1 was a ground-up development adjacent to one of our existing sites. And now we're pretty heavily looking into industrial outdoor storage. We have 3 deals under contract right now, and a pretty healthy pipeline that we want to execute behind that.
How do you find out that there's institutional interest in a specific sub asset class, and that expect that it's gonna grow over the future? Is there a repeatable process to discover that, or is it different every time?
I think it's just being out in the world and talking to players of various sizes, from the big private equity firms to the more boutique guys, the family offices, the individual syndicators, and having a really good network in each of those categories to see what people are looking at and what's interesting.
Let's take one of those sub asset classes as an example. If you could just talk about, how do you find opportunities to buy in that specific sub asset class?
This is good. This is an intersection of your space and my space. So I'll take industrial outdoor storage, which is our current focus. And finding the deals is, I would say, at least half of where we derive value. And so we've really focused in the last few years making our acquisitions process more efficient and more comprehensive. And that includes using technology. And real estate is just traditionally like the last industry to adopt technologies. And so we've tried to be a little bit ahead of the curve on that. And so we actually are investing in a software that kind of helps make that process more efficient. It's called Prophetic AI, and I think they're going to be really successful. But we look at acquisitions from a market identification perspective first. So what markets do we want to be in based on a cross section of our expertise and where we feel like there's opportunity and not a lot of competition. Once we identify those markets, we will look at every piece of zoning that allows industrial outdoor storage, and then start picking off and cold calling off market opportunities. And that process is much more robust if you can use AI to help you out a little bit. And then, so that's like the kind of like the numbers piece of it. But the other piece is really relationship based, and that hasn't changed. It's exactly the same as it was 10 to 20 years ago, working with leasing and investment sales brokers on the ground in the markets that we're in to call on our behalf to bring us deals when they hear about them instead of bringing them to the open market. And so it's a combination, I think, of both of those things. Most of the opportunities that we identify in industrial outdoor storage are off market. And so it's a leasing broker or sales broker that we hope to do repeatable business with, who's bringing us an opportunity.
I hear from a lot of folks in real estate the value of buying off market, buying something that's not listed or pocket listed. And I guess I've always wondered, and I've never heard a great answer for, why would a seller want to engage in a transaction like that? Why wouldn't the seller want to go to market, have an auction dynamic, and try to get the maximum price?
So I think the short answer is a lot of sellers are not that sophisticated. When we look at industrial outdoor storage, 90% of assets are owned by mom and pops and owner users. And so when someone calls them and says, hey, listen, I can get you $10 million in your pocket in 90 days, people kind of just say yes without kind of thinking about, do we want to run a full process? And on the off market thing, I know it's something that everybody says. I'm not totally convinced that there aren't great opportunities that are fully marketed, because everybody sees the world a different way and has a different business plan that they want to execute. And at the end of the day, what makes great sponsors is not just the ability to buy, it's your ability to execute a business plan in as quick of a time frame as possible. And so it's not just to buy. And I think that especially in this environment, we're seeing it shake out as we look at what's going on around us. where people made great buying decisions, but they didn't execute their business plan properly. And there's so much of a focus where you see some of these sponsors where the whole focus and the whole team is just focused on acquisitions. And then you ask them how deep their asset management bench is, and it's pretty thin. And so I think there's a big difference between great and okay operators, especially in environments like today.
When you're thinking about converting on a deal, how many would you have to reach out to look at or diligence how many to actually get a single conversion?
How many do we underwrite, like do full underwriting versus actually buying?
And even like a step above that, like before you decide to underwrite, how many are you?
I mean, we look at hundreds of deals a year, and we actually execute on maybe, like this year, we'll maybe execute on somewhere between 6 to 10. I mean, self-storage last year, we closed on 2 deals. We underwrote, we looked at a few hundred, and we probably underwrote 50 or 60 of those, and we closed on 2 of them. And so the filter is, I mean, we're looking at every deal that's openly marketed in the target markets that we're in addition to seeing most of the pocket listings and off-market opportunities.
And how much does the purchase price and finding something matter to the outcome versus what you do with it afterwards? You mentioned, the business plan, the operational aspect of it. How much weight would you put on that relative to making the right buy?
Most people probably say 75% of the buy and 25% on the business execution. I think it's probably 60% on the buy, maybe, and 40% on the execution. I think the execution really good asset management is undervalued by probably at least half of the sponsors out there and even in the asset classes that are a little bit less management intensive, you have to do a good job. I mean, there's just the attention to detail is super important. And at the end of the day, asset management and property management is sort of just applied common sense, but it's also follow through and attention to detail.
Yeah. Operational excellence, maybe. Is that like a fair term to use?
Yeah. And that was hammered into me. That was one of the 4 pillars of the shopping center REIT that I worked for in 2008.
What were the other 3 pillars?
Oh God, now you're testing me. It was something about acquisitions, and then property management, and then our ability to kind of figure out how to upcycle the portfolio. So to get rid of the lower performing assets and replace those in an accretive manner with better acquisitions.
Were you guys in the business of packaging those for a larger investor then? That's kind of how you had your exits?
They were starting to do that when I was there. They had two partners for joint venture investments, and then they expanded after I left to include, I think when I started, it was DRA Advisors and CalPERS, and then they started working with Blackstone shortly after I left, and then packaged the whole company for sale to Regency Centers a few years after that.
Having looked across different sub-assets and in different paradigms, what are some of the most important things that you look for when you're underwriting to identify if this is a good opportunity or not?
I always look for what opportunities where I can find better risk-adjusted yield. When I look at if I zoom out and look at my whole portfolio, real estate and non-real estate, at the end of the day, the non-real estate portion is all private markets, venture capital, private equity, and it gets tied up for a really long period of time. I mean, that's sort of the game that you're in. And I rely on my real estate portfolio to give me yield so we can take care of our family in the interim in between all those capital events. And so we're very yield focused. So for industrial outdoor storage as an example, we're looking for opportunities where stabilized yield within, call it a 12 to 24 month period, is anywhere from 7 to 8.5%, give or take. And that it's hard to find opportunities that hit that 7% because we're looking at primary markets all over California, from Sacramento all the way down to the border in San Diego, and then Phoenix, Seattle. I mean, these are markets that people want to be in. And so finding yield like that is difficult. And the other thing that you have to remember with real estate is that when we get that yield, it gets taxed as return of capital. It's not ordinary income. And so I always encourage investors across different asset classes over long periods of time. You have to be comparing your after-tax returns, not your pre-tax returns.
Yeah. In the early stage VC world, we talk about QSBS all the time. That's our hook for folks. It's not, I don't know if it's as good as the combination of cost seg and 1031s and the world that you operate in. It seems pretty advantageous as well.
We have some venture investments and some QSBS stock, but it doesn't compare to real estate because you get the depreciation and it offsets if you're a real estate professional, it offsets your ordinary income. So if you can have enough depreciation, if you're buying stuff every year and you're offsetting the majority of your ordinary income, that's pretty hard to beat.
The perfect couple. You need one person in VC getting that QSBS, the other person getting high yield with the real estate professional tax treatment. That's the right balance.
That is definitely the right balance.
The power couple.
That is the tax efficient power couple for sure.
Let's go back to underwriting for a second. I appreciate what you're saying in terms of risk adjusted return. I'm curious, are there things that you see other investors over-indexing on or caring about that you think it's not important, it's a red herring, something like that?
I think a better way to think about it is looking at other people's decks. Like what are the red flags that I see that I always encourage my non-real estate friends. If you're looking at a deck and you don't want me to look at it, or I don't have time to look at for whatever reason, these are the quick things the quick checklist that I would look out for as you're underwriting a deal. The first and most sensitive is going to be your exit cap rate. And I see a lot of people being more aggressive on exit cap rates than I think we would feel comfortable with. And at the end of the day, a cap rate is just an inverse of a multiple. And so if you're multiplying at a 5 cap versus a 5.25 cap, that 25 basis points is a big difference in terms of your returns. Every 25 basis points is a big difference in your returns. Interest rates, we see a lot of people right now underwriting like a bridge loan for like 18 to 24 months and then a really low interest rate after that. I think that's a pretty risky way to look at the world right now. And then in terms of market rent growth, how accurate is the rent that they're underwriting today for what rent is today, and how aggressive are people on rental growth? Is it 1% growth, 3% growth? Anything more than 3% growth is a little bit, I think, aggressive in my mind. I'm like conservative and old school in that way, but I do like to see that there's some gradual bumps. The exceptions to those are areas where the rent is, and that's like kind of just vanilla multifamily. With other asset classes like industrial, where you can bump the rent and there's no limit on how much you can bump the rent. That's different. That's like, okay, really, what is market rent? What is true market rent today? It's fine if market rent is 20% off what the tenant is paying right now. And that's understandable if you're dealing with a mom and pop landlord or an owner user.
There's a lot of dynamics in understanding what the market rent will be in the future as well, right? It seems like sort of lockstep growth has not proven itself out over time, just like constant 3, 4, 5% increases. What have you seen folks doing that strikes you as sophisticated or cutting edge with regard to demand forecasting or supply forecasting in different sub-asset classes and sub-markets?
So I'll attack multifamily first. And I'm not an investor in this company, but I thought that what they were doing was pretty clever. And the founder, when we spoke to him, was quite smart and had bootstrapped the company to a place where, they had a pretty great product. And that's Hello Data, I think is what it's called. And then that allows you to look at all the different market rents in the competitive area that you're in. So as you underwrite, it's easy for like an LP to open it up and look at what market rent is within a 3-mile radius, how many vacancies there are, and has all that kind of market data. And so it's been much better. I've seen more aggregation of data in an efficient manner in the multifamily and then the home builder space. It hasn't really translated as much into other asset classes yet. But I do think that visibility in terms of forecasting demand, vacancy, market rent, and aggregating that data is just going to make the markets more efficient over time. Self-storage has a similar platform in Radius that aggregates all the asking rents, web asking rents.
Yeah, it seems like generally folks are thinking about and talking about the demand side of the equation across sub-assets, but the supply side is pretty hard to predict beyond maybe the next 1 to 2 years, given how volatile all the various inputs are there, and things can change pretty quickly.
And that's a really astute observation, is that people focus way more on demand than they do on supply. And supply is just as important as demand in that supply demand dynamic. And so I'll speak a little bit about that with multifamily and industrial, which are the two areas that we're focused on right now. With multifamily, we're seeing demand go up faster than we're seeing construction starts. Construction starts are down like 70-80% across the US right now. And that varies by market.
How much of that is that just labor and inputs, or is there something else that's driving that? Like the borrowing cost is also pretty high.
It's a combination of both of those things. Construction costs have gone up quite a bit during COVID. It's 30-40%, maybe even more. And so what started happening as interest rates went up is that things started to trade at below replacement costs. And so if you can buy something that's already there at less than the cost it takes to build it today, that kind of seems better than taking the development risk. And as a result, I think there will be they're predicting that in 2-3 years, that demand's going to really outstrip supply, and that's going to drive rental growth. I don't know. I don't have a crystal ball. I don't know if that's going to materialize, but that's certainly kind of one way to look at the world today.
The replacement cost argument is an interesting one. So it makes sense to me, right? Like all of the inputs have gone up, the cost of money's gone up, so replacement cost has gone up relative to where things are trading, and things are not trading at a higher price because rents haven't kept up with the growth in costs, right? And then similarly, I don't know about all these different submarkets and assets, but it seems like at least in residential in most markets, there was a massive increase in prices over the 2021, 2022 timeframe. And in some places, things have started to come back down where there was a construction boom, but otherwise they've kind of plateaued. They're not growing, but they haven't cratered. So I'm saying, like think about Austin as a market that's corrected with supply growth, but then Los Angeles or San Francisco is kind of held even in most zip codes. And the rents haven't come up commensurately to where asset prices are or to where costs are. And so arguably the replacement cost argument seems a little off. You wouldn't build something new because the rents wouldn't justify it. But so the price that something trades at should be lower. It doesn't mean necessarily that it is correlated to where rents are, though. It might still be elevated on a relative basis.
And that's a good point too. And I think the big bump in rents happened more in the markets where there was a ton of construction and a lot of buzz. Austin, Nashville, those are two really big ones that come to mind. Those have come down quite a bit. And in the kind of more infill markets like San Francisco, LA, Silicon Valley, rents have started to tick up a little bit. I mean, I know in Silicon Valley, rents are ticking up year over year, but for the most part, in some of the other markets, staying pretty flat. But I mean, it's also a function of where the big institutions want to place money has a big effect on fundraising, filtering all the way down to the smaller syndicators who are doing 20 to 30 unit projects. And so if the big institutions are not taking a bet on development, that means that everybody's kind of got their hands up and say, well, if Blackstone's not doing it, then like, do we really want to take that bet right now? And that's one of the differences that we've seen in 25 versus 22, 23, and 24 is that the institutions have capital to place in real estate, and they are making pretty targeted bets in different areas. And then once the institutions do that, then, 6 to 12 months later, the family office investors and the smaller private equity groups, they follow what the big institutions are doing.
That seems pretty similar to venture in some ways. All the mega funds are doing AI, so everyone else is now like, okay, we should be doing AI. And you want to be thoughtful about who's going to mark up your deal in 2 years or 4 years, whatever round you're thinking about. I want to ask you a little bit about time horizons and vintages and how you think about diversification or using those things to your advantage or how they can be used against you. That's a pretty broad set of topics, but can you share just a little bit about how you think about those things, hold periods, that kind of stuff?
I think one of the competitive advantages of being a long-term investor in a family office is that we can really optimize hold periods for outcomes. We don't have to sell because we have a 5-year like closed-end fund. And that allows us to look at, seeing a run up and then taking money off the table and being measured in that respect. But we typically like to say like we'll sell anywhere from 3 to 6 years. But if we get to 6 years and the timing's not right, there's not a lot of transactions in the market, it's not an asset class that people are really excited about, we have the opportunity to hold it for a little bit longer. But I mean, we're just like you guys, we're IRR based investors. So if we're going to hold it, we're taking that bet that the increase in value is going to be larger than kind of the extra, the cost of holding it a little bit extra. And the other part of real estate versus kind of venture is that when we do sell, we have the opportunity to defer paying capital gains tax by 1031ing into another asset. And so we usually try to 1031 if and when those transactions do come up. So in terms of vintages, I mean, we look at vintages usually by kind of decade or economic cycle. And this economic cycle has obviously been longer than the ones that came before it. But that's sort of how we think of things. It's hard to look at success in a 12-month period when you're either in venture or real estate. It just doesn't work that way.
When you're thinking about these whole decisions, it feels a little analogous in venture where, you've invested in a company maybe once or twice and it's not an absolute breakout, but you see things that you like, or the team seems to be operating well, even if the market's not responding yet, or vice versa. It's not a slam dunk of a yes, and it's not a hard no to reinvest. And you kind of have this tricky decision to make. That feels analogous to being in a property for, a few years. Maybe you underwrote it for 3 to 5 years. You're reaching into that timeline, and it hasn't gone as well relative to where you think the market would be pricing it, but you think it's still performing okay. How do you make the decision to hold something versus exit below your expectations and then find the next opportunity? How do you make that when you have like a stark alternative, but you don't have a lot of clarity on where the future is?
It comes down to general capital allocation and what the other opportunities we have to replace that capital look like. And so if we feel like the transaction market is really favorable and we can get out at in a pretty decent way, then that would kind of motivate us to get out and replace that capital. Versus if we look at the market and we say, the transaction market is pretty stagnant right now, maybe we can sell this, but we're going to take a hit on it, and we don't quite know what we would buy to replace it, then we'd probably veer towards holding the asset.
Yeah. So your opportunities, your alternatives at the moment really are the key decider.
Yeah.
I think the same thing's true for us. I think it's often just about looking at each opportunity with fresh eyes. So whether it's your second investment or third investment in a company, you're looking at your alternatives and you're trying to figure out if I wasn't already invested, how would I react to this? Would I be excited? Am I biased one way or another because of the investment I've already made, and try to think about it fresh? But that's a different mindset, maybe a little bit, given that we have a much higher tolerance for losses in an early stage venture than pretty much any other asset class.
Yeah. And I think venture is like, when we've invested in venture, that's where we've always struggled, is like, okay, we like the company at first, second, and then there's always those companies that kind of hit that point where they really can't raise more capital. They have to rely on their existing investors. And sometimes you do bridge those companies and they turn out great. Most of the time you bridge those companies and it's kind of
the same.
It's a bridge to nowhere. And so trying to figure out what is that 1 in 10 that the third, the fourth round of bridging is going to get them to where they actually need to go. And in my experience from venture, it's really like 1 in 10. Do you really see that to be a bridge to somewhere that's going to be really profitable? But it becomes harder because you get to know the founders and you know that their vision is the right vision. It's just, can they execute that vision? It's same as real estate. It all comes down to the execution piece. Anyone can have a good idea.
I want to ask you about your best and worst investments ever. Let's start with the best one. Can you just tell us the story of how you found it, what made it so great? When did you know it was going to be a great outcome?
I'll talk about kind of just recent memory. One of my favorite self-storage deals that we did, and this one was outside of Sacramento. And when we bought it, I mean, when I buy them, I always second guess myself the week that we're closing and the week after we're closing. I think that's true for me actually in venture too. It's that level of uncertainty, right? When you execute, that you don't know whether the investment's going to be successful yet. And I had the same exact feeling with this one. And we put in Life Storage, which is now Extra Space, built a bunch of our vision. And this was actually an openly marketed deal, even though everyone wants the off-market deal. And we just had a different vision on how to execute the business plan than the other people looking at it. So we put a bunch of portable units in the back of the property. They're not that portable. We kind of weld them together, but they come as modular units that they come and then you just assemble them on site.
Are they just lower cost than any alternative?
They're lower cost, and you get bonus depreciation. So in the year that we had purchased it, it was 100% bonus depreciation for our investors. And so that's a big win for our investors to take most of their investment. If you make $100,000 investment, you have like $70,000 of depreciation on it in year one. and you're a real estate professional, I mean, that's a great bet. And the construction of the units took a little longer. It was during COVID. The supply chain was still a little bit messed up. It took a little bit longer, which is like every construction project. And then the lease up was kind of a little bit slow. And then all of a sudden it started picking up, and then we were able to really push rate. And now I think our revenue is somewhere like 15-ish, close to 20% above what we thought we could get for stabilized revenue. And I say that one is my favorite because there were struggle points in between. And if you're using your venture analogy, it's the 1 in 10 where it struggled a little bit in the middle and then turned out to be a breakout success. I don't know why, but I find those ones to be way more satisfying. It's fun to see, kind of, because you've been through that whole emotional journey with the asset, and we'll probably sell that asset at the end of this year, and we will definitely exceed the returns that we had promised our investors. We know that we're far enough along. We see what the market's doing. We know that with pretty good degree of certainty right now.
Yeah. I think there is probably something about how we were raised, and like maybe it's like an immigrant or Asian thing, but just like it's not supposed to be easy. It's supposed to have some kind of challenge. I don't even know if it's like an immigrant or Asian thing, but it's also like even like Disney stories, right? There's that hero's journey you have to go through to get the reward, and if it's easy, it's not as sweet of a reward.
Story's not as good.
Yeah, I think that's part of it.
And I won't skirt your question. I'll tell you about my worst investment as well, because it wouldn't be fair.
I was going to ask again if you didn't. Don't worry.
And I knew you wouldn't forget about it either. So we'll attack it. My worst investment was probably one that I made in 2016. We're coming out. We'd sold a big shopping center in Oregon, and we're trying to replace it with a 1031. And I was pretty early in my career, and I just joined the family business in 2014. And most of my experience, other than what I'd seen with my family to date, had been shopping centers. I knew shopping centers really well, and the other asset classes, not quite as much. And in an institutional shop, you always have backstops and people to help. And there's always multiple checks and balances. And I've built that in to Westlake in the last 10 years. But this was like less than 2 years into my journey at Westlake. And it was just me and an analyst doing acquisitions. And so we bought a little bit of street retail in San Mateo, California, great market. And our goal was to buy it as street retail, and re-entitle it to multifamily, and either sell it as entitled land or build it ourselves. And it was kind of a funky layout. And the short story of it is I basically miscalculated the acreage and how many units that we could build on the site. And it is to this day, like the only major, I think, knock on wood, the only major mistake I've made during due diligence. But we grossly overpaid for that asset, and we got super lucky. I think the city bought it at the end of last year after an 8-year hold period for about the same that I bought it for in 2016. And that was like that. I mean, that's a big loss in my mind, but it could have been a lot worse. But it was I think the reasons behind why it was a bad investment make it the worst investment, because there's no reason that a good real estate investor should miss something major in due diligence.
Yeah, no, I appreciate the candor and being so open about that. And all things considered, you still came away with your capital back, right? So from my world, total loss being a common thing, it's not so bad, even though I guess it was the opportunity cost. The whole period was meaningful.
Yeah, the whole period was pretty meaningful. And it's exactly like venture in that your losers take up more time than your winners.
Yeah. I can imagine the things you had to go through to figure that one out. I want to talk about fundraising. I know that you've done that for some of your deals. Can you share when the first time was that you ever raised capital?
Sure. It was about, I would say middle end of 21. So about 4-ish years ago, 3.5, 4 years ago. Not the best fundraising environment. And I think it was just naivete that I thought that like you'd call people and they'd be really excited. You're really excited about it. They'd be really excited about it. Real estate is fairly similar to venture in terms of hit rate. I would say is that like most people who are starting out are going to get way more no's than you are yeses. And I think it's an acclimating process to kind of get used to those no's, and just that normalizing that process, I think took me a little bit of time. And I will forever, no matter how many years pass, will always be super, super grateful for the people that invested probably in those first two deals that happened within the first 6 months and took a bet on us. It's really, I mean, you're really betting on the person. It doesn't matter what my family's track record was. We had a great track record the first 4 decades, but people want to know about your track record and your record specifically with raising outside capital. So if you've never done it before, they're just betting on you. You have no track record.
How did you find the first set of people in that first deal, and how has it evolved over time now to who you reach out to pitch a new deal?
Literally family and friends. So all of my best friends from business school, my parents' friends, my friends from living here in San Diego, and then our own capital. We put 10 to 30% of the capital in. And for those first few deals, I think they were all around that 30, somewhere around 30, somewhere even closer to 40%, because we backstop it at the end of the raise. So we come in and we're like, we're buying this asset no matter what. And if we're short on fundraising, it's our balance sheet that fills the gap.
I think that's probably something that sets you apart from a lot of investors, and is something that I think LPs respond well to, seeing a GP who's very committed and is putting up a significant portion of the deal or the fund or their personal capital, whatever their denominator is. Just seeing that skin in the game seems like a really important signal for most investors.
For me, it's a really important signal, whether it's a VC investment or whether it's a real estate investment. And I have so much respect for founders who are able to bootstrap their companies up to a certain point where they really do have true proof of concept. And with real estate, it's the same way. There's nothing worse if you're looking for one of the bigger red flags in real estate deals, where you see like a 3% acquisition fee and a 3% sponsor co-invest. That's like that. There's no way in no universe that's a good deal, irrespective of what asset class it is.
It's an inherent misalignment, right?
Yeah.
Okay, we've got two segments left before we're done here. Our second last segment, the newer one, where I ask people for what I've now disclaimed to be not legal, financial, or tax advice, but just what would you advise someone who's an entrepreneur that's had an exit or an early employee at a nicely exited company, someone who's sitting on, call it 5 to 10 million, not done. They don't want to retire, but they want to invest intelligently and kind of keep building whatever the next thing is, their next job, next company. How would you advise them to allocate across all the options, given also what your areas of expertise are?
I think now is a really good time to invest in real estate. We are at the beginning of a cycle. And I think a lot of people whose portfolios I see that are in that $5 to $10 million range are pretty light on alternatives. Usually they have pretty vanilla public equity portfolios. And I think public equities right now are pretty fully or potentially overvalued right now. And so I think alternatives, whether it's private equity, real estate, or venture, and having, call it 20 to 30% that you set aside, especially if you're young and you've already had an exit, you can do something again. And that's really, that 20 to 30% is really where you find A, alpha, and B, that's where you're going to have your big wealth creating moments. And then like, at least for me, like my public equities portfolio is pretty vanilla. It's direct indexing. It's nothing that exciting. And then we've started to do some long, short tax harvesting, which I think is sort of all the rage right now. But that's a really good way that we've found to kind of slowly start to divest of a concentrated position, it came from a venture investment, and it is pretty typical as a venture problem that people have.
Are you guys doing that on your own, or are you working with like a third-party manager to help with that?
We're working with one of the third-party managers to do it. So the big guys are AQR, Quantino, and then a few others. We're working with Quantino to do it.
Well, thank you for that non-financial, tax, or legal advice. We're going to go to our last segment here, the lightning round. One fun question and a few deeper questions. The first one: what food would you eat if you could only have one food for the rest of your life?
Steak.
All right. Any kind of cut? How do you like it cooked?
Ribeye. Just ribeye.
Just ribeye. And you strike me like a medium rare kind of person.
Rare to medium rare.
Rare to medium rare. Okay.
More than that, you're killing the cow twice.
All right. Very fair. What has been the hardest lesson you've had to learn in your career?
I think it's been the importance of attention to detail. I mean, I think most people can say that there's one or two moments where they kind of skipped over something that was important. Back to my worst investment of of all time, that was a lack of attention to detail.
Has that been something that you see across the industry as well? Is that something that you think is just kind of your personal journey?
Oh, I think a lot of sponsors miss one or two things in diligence. It's not that uncommon. And so being with a sponsor that's been doing, I mean, that's part of why people care about track record, is being with a sponsor who's been around the block once or twice is pretty important.
I think it's very true in venture as well. A lot of the stories that you hear, right, of things that go terribly in terms of bad behavior by founders or by management, or just being perfectly misaligned in an industry. There's maybe a nature of disregard for details when you're building a portfolio and you know that some companies are going to be a zero anyways. You just don't go as deep. But I think there's also like a time dynamic you see a lot in venture where opportunities are sometimes only available for a week, 2 weeks, maybe even less sometimes. And so if you want to make a decision, you're being pushed to that very quickly. And it takes a lot of discipline to just say, I'm going to do my full diligence or I'm just going to miss this opportunity. So we see that too.
It's exactly the same as venture in that respect, especially when you're thinking about off-market opportunities. You have such a quick window, and same with venture. All the best companies are the ones that people are going to be hyping about, the ones that you have a week to make a decision on, and it is tough.
What has been the best moment of your career so far?
I think closing that first fundraise was probably one of the best moments. And I know you've heard about this project, but we're building 328 units in Santa Clara, ground up, and the fundraising has been challenging, even though I think it's a great investment. And we are signing an MOU today with a big institution, which I just didn't think that it was going to be in the cards for us and in the future when you talk about that vision for what I was building to work with institutional investors. And it kind of feels a little bit surreal that that's looking like it's going to be part of our future.
Yeah, that's exciting. I'm excited for you. Okay, last question for you here. Who has helped you the most in your career so far?
I would probably say there's the CEO of the company that I worked for right out of college. I interned with him when I was a freshman in college and then came and worked with him full time for 3 years, first in acquisitions and then as his chief of staff for the last 2 years. And I think his name's Jeffels, and he runs Vornado's shopping center platform right now. But he was really big in terms of mentoring me and then also teaching me how to be a CEO and what a good CEO does.
That's our last question. I appreciate you sharing so openly and joining us today.
Awesome. Thank you so much for having me.
Thanks, Kristina. Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.